Hello, in this video, we'll be going through uncertainty in income tax. So when a company files their tax return, their goal is always to either reduce their tax liability or delay their cash outflow by reducing their tax liability today, knowing that they'll have to pay it at a later date. When a corporation files their return, the positions, we call them the tax positions that they take on their tax return might differ from the position the IRS or other taxing authorities might take on the same item. So if management can reports a tax item one way on their tax return, the IRS might come in and say, no, we think we should treat that item differently. And when a company is under IRS audit, it could take many years to resolve those items, especially when you have Fortune 500 companies. The IRS is usually, I won't say always, but oftentimes will be behind. So if you're filing your 2025 tax return, then it might not be even, the IRS might not even start to audit that tax return till 2027 or 2028. And then it might take a couple of years to audit before the audit is final, all relating to 2025. So it could take many years to resolve these uncertain tax positions. And if that position, if the company took a tax position on the tax return one way, and then upon audit they realized they will not get that deduction or they have to recognize more revenue, then it'll have to pay more tax than it originally recognized on the tax return. So how do we account for such uncertain tax positions? Because this certainly happens in the real world, where there's often tax positions where companies think they may or may not sustain under audit. It's a two-step process to decide whether we need to record an extra liability or not. First, step one is a tax benefit may be reflected in the financial statement only if it is more likely than not that the company will be able to sustain the tax position based on its technical merits. This means that on the financial statements as a whole, okay, this is not the tax return, okay? This is not necessarily a tax return. This is the financial statements, right? What you see on your 10K. The tax benefit means your overall tax expense or tax benefit has to reflect the position only if it's more likely than not that that position will be sustained based on its technical merits. And step two is how much of a tax benefit should you record in your financial statements should be measured as the largest amount of benefit that is cumulatively greater than 50% likely to be realized. We're going to go through these so it makes more sense with an example. Let's say on my 10K, right, I have sales of 200 million, cost of goods sold 80 million, gross profit of $120 million. And in this year, I received, meaning a corporation, received a state government grant of $40 million to build some sort of factory in that state, right? They gave me this incentive grant to build a factory, so it creates more jobs, more taxes, etc. Brings more economy to the state. Well, that $40 million for financial reporting purposes is income. So now my pre-tax accounting income is $160 million. Remember, this is before we calculate any tax. This is not including the tax expense that's recorded in the 10K. It's our pre-tax accounting income. We file our tax return, and what we're going to do in our tax return is we're going to start with our pre-tax accounting income, but for this government grant, our taxable income, everything that they account for in pre-tax accounting income is the same for tax purposes, except we think that this state government grant should not be reflected as income on the tax return, but rather contributed capital, right? It contributed capital. It's like a return of capital, or maybe it's an investment from the state into the company of some sort. But for tax return purposes, or for tax purposes, the corporation feels like this should not be recorded as income, but more as investment or capital contribution. And so therefore, when they file their tax return, they remove the $40 million, and their taxable income is $120 million. Let's say we have a tax rate of 20%, and therefore our tax payable is $24 million. So our entry to record that would be income tax expense, $24 million, credit income tax payable, $24 million. So that's what we file on our tax return, right? This is what gets filed with the IRS, this tax return. However, we do not think that it is more likely than not that we will sustain that tax position based on its technical merits once we get under audit by the IRS. And if that happens and the IRS would disallow that $40 million reduction in income, right? They would say, no, you have to recognize that $40 million. Then our taxable income would have been $160 million. And at 20%, our tax liability would have been $32 million, right? So in that situation, we would have recorded income tax payable of $32 million and income tax expense of $32 million. But this is not how we want to file our tax return. We think we do have a chance of getting that $40 million as, not having to recognize that $40 million of revenue. So when we file a tax return, we're going to file it like this. This is how we're going to file a tax return. But because we don't think we're more likely than not going to be able to sustain this position, we are not able to take this tax benefit. And when we say tax benefit, it means that if we just recorded what we filed on tax return, we would have an income tax expense of $24 million. But really, based on what we think it's not more likely than not that we're going to sustain this position. Our income tax expense should be $32 million. So by not recording the $32 million, we would be taking an $8 million tax benefit. And that's what it's talking about right here when it says a tax benefit may be reflected only if it's more likely than not. So that's what it means by tax benefit, that I will only record $24 million of income tax expense instead of the $32 million if I don't think that this position will be sustained under audit, or based on its technical merits, I should say. So here's what happens. We cannot, none of that tax benefit, which is the reduction in income tax expense, is recorded in the current year if it's not more likely than not that we're going to sustain this tax position. And the income tax expense must be recorded at the same amount as if the tax deduction was not taken. So our income tax expense has to be recorded at $32 million, right? This is as if we didn't take that that tax position, not recognizing the $40 million. So how do we do that? We're gonna still record income tax payable for $24 million because that is what we filed our tax return. Our tax return says that we owe $24 million. That's based on this column right here, right? Where we do not recognize that $40 million of income. So our tax payable has to be $24 million. Our income tax expense has to be $32 million, right? It's not reduced by the $8 million tax benefit. And so what we do is we record another liability, right? This income tax payable is a liability, but we will record another liability, and we're going to call it uncertain tax position for $8 million. This way, it allows us to show $24 million of tax being owed on the tax return, which includes that $40 million, that we don't recognize that $40 million of income. But on our financial statements, we are reflecting income tax expense of $32 million, we do not have that $8 million benefit, right? We don't show $24 million income tax expense, but we're showing the 32. And we do that by creating this new liability uncertain tax position. So we said this is a two-step process, right? Step one, to see if you need to record uncertain tax position, is the tax benefit may be reflected in the financial statement only if it's more likely than not that the company will be able to sustain the tax position based on the tax merits. However, a tax benefit should be measured at the largest amount of benefit that is cumulatively greater than 50% likely to be realized. In our previous scenario, we assumed that the full $40 million, right, which means $8 million of tax benefit would not be allowed, would not be sustained upon audit, right? So we recorded an $8 million liability for that. But let's go to a different scenario where we don't think that the full $40 million will be disallowed, that the government will only make us recognize some of that income, but not the full $40 million. So let's look to see what happens then. You have to measure what the tax benefit is. So these are tax affected. These numbers are tax affected of what we think the tax, the amount of tax benefit that the management expects to be sustained. So meaning if we think the full $8 million, which that's tax affected. So that would be, if we think the full $40 million of income will allow to be, the IRS upon audit will allow that not to be recognized, right? We think that there's a 10% likelihood that that tax position will be sustained, okay? Now, we also feel that there's a 20% likelihood that the IRS would say, or the taxing authorities would say, you know what, you can disallow 35 million, not the full 40, but 35 million, which would be $7 million of tax benefit that would be sustained. So we think there's a 20% chance of that happening. So cumulatively, we're at 30%, right? We have a 10% scenario plus a 20% scenario. Now, we also feel there's a 25% chance that upon audit, we will be able to sustain where $30 million of that $40 million should not be recognized, right? So that the IRS will make us recognize $10 million of it, but will allow $30 million of it to not be recognized for tax return purposes. And so in that situation, we would have a $6 million tax benefit that we would be able to sustain, okay? So now we have a scenario with 10%, a scenario with 20%, which gives us cumulative 30, and a scenario of 25%, and cumulatively we are at 55%. And so whatever scenario puts you at the over 50% mark, that is what you need to record in your financial statements. So in this situation, we think that $6 million of tax benefit will be able to be sustained. So let's see how that's recorded. So if that's the situation, we would still record, let me just erase that. Our tax return is still going to disallow that full $40 million of income, which means our taxes payable will be $24 million. So we would still record credit income tax payable $24 million. Now that $24 million includes an $8 million benefit, right? Because if we recognize that full $40 million for tax, our income tax expense would be $32 million. So that income tax payable has an $8 million benefit embedded into it. We think that we will be able to sustain 6 out of that $8 million benefit. So, which means that $2 million we do not think we're going to sustain. We think that the IRS is going to tell us, I keep saying IRS, but it's the government, or when it's under audit, is going to say, you know what, you can you can remove $30 million of income for tax purposes, but the other 10 should be taxable, right? And then if you take that 10 times 20%, that would be $2 million. So we're going to record this liability for uncertain tax position for $2 million. And then the plug is going to be income tax expense, which will be $26 million. Let's go through a concept check. Bagwell took an aggressive tax position that reduced taxable income from $500,000 to $100,000. Bagwell does not believe it is more likely than not that it would prevail in court if the position was questioned. Bagwell pays a tax rate of 25%, and Bagwell's journal entry to account for taxes would include what? So they took a tax position that reduced their income from 500 to 400. So they took this additional deduction on their tax return for 100,000. At 25% is 25,000. So they need to, their tax return shows $400,000 of income, but we think upon audit or it would not prevail in court and that we would owe this additional $25,000. So the entry for that, is going to be our taxes payable is 100,000 because we would take the 400,000 times 25%, that's our tax payable, and we need to record this extra liability for uncertain tax position, the 100,000 times at 25%, and then to balance is income tax expense debit $125,000. Okay, let's continue and say Bagwell took an aggressive tax position that reduced. This is the same thing. Okay, now assume that Bagwell believes it is more likely than not that it would prevail in court if the position was questioned. Bagwell believes that there's a 40% chance that 100,000 would be prevailed, a 20% chance that 80% would be, that 80,000 would be sustained, and a 40% chance that 50,000. So they think that 100K, there's a 40% chance that the IRS, that the government would allow that, okay? So cumulatively, we have 40%. Then it tells us that there's a 20% chance that 80,000 would be sustained. So 80,000, they think, sorry, not percent, 80,000 is going to be, there's a 20% chance. So cumulatively is 60%. That's supposed to be a plus, but it doesn't look like. So we take the 40% plus the 20%. So this brings us to the over 50% marker that we need. So we think that of this $100,000, right, that we didn't record in the tax return, that we would get to the 80,000 would be sustained, which means $20,000 would not. That the government would say, no, you still have $20,000 of income that you need to pay tax on, and times 25%, that's going to be $5,000. So in that situation, we would still record a tax payable of $100,000 because on our tax return, we only show $400,000 of taxable income. At 25% is $100,000, and we would record this uncertain tax position of $20,000 times 25%. Okay, and then the rest goes to debit income tax expense. Okay, now what happens when everything's been resolved, the audit is over, and let's look at what happens to that liability, that uncertain tax position liability. So let's see how we resolve it. Number one is worst case scenario. So the entire position is disallowed such that the company owes that additional $8 million in tax. So remember, the taxes payable, no matter what position we took, was $24 million, and that's how much we actually paid to the government, okay? And so the worst case scenario is that the government said, oh, that full $40 million has to be recognized on the tax return, and so times 20%, you owe the additional $8 million, okay? This resolution, this assumes that we only booked $2 million. We went to the later scenario. Remember, we booked $2 million for the liability and uncertain tax position. So now we owe the government, we owe more income tax payable of $8 million, or if we paid it, we would pay $8 million, right? We have to reverse, we already have a liability for $2 million, so we would debit our liability, and then the rest goes to income tax expense. So we record income tax expense for $6 million. Okay, so now what happens, best case scenario, is the entire position is upheld, which means that the way we file the tax return showing that none of that $40 million of income is taxable, that the government agreed with us, and we owe no additional taxes, right? Because again, we paid our taxes payable was $24 million from our tax return, and that's what the government said we owed, right? We owed that, we paid it, great. So now we can write off or remove our liability of uncertain tax position. So we would debit that $2 million, and the credit goes to income tax expense. And what if we have the expected scenario, which was that we thought the $6 million benefit would be sustained, which was meaning that we thought that the government would allow us to not recognize $30 million, but they would make us recognize $10 million of income on the tax return, right? Tax effect is $2 million. That's how we book this liability. And now that's actually what happened. And so what would happen is we would debit our liability and we would credit income tax payable, or if we just paid it out to the government, right, that cash of an additional $2 million because they're making us recognize that $10 million of income. Concept check. Now assume that Bagwell took an aggressive tax position that reduced taxable income from $500,000 to $400,000. They recorded a liability uncertain tax position for $5,000, and in a later period learns that the entire position was upheld in court. Bagwell pays a tax rate of 25%, and so what would be basically what's their journal entry to record this? So what this saying that their entire tax position was upheld in court, what that's saying is that the entire $100,000 did not need to be taxed. So whatever they record on the tax return was appropriate, right? They recognized $400,000 of taxable income on their tax return, and under audit, that's what the government said they should owe. So in the meantime, they've recorded this uncertain tax position liability of $5,000, right? So we need to remove that because we don't own that money anymore. And the credit is going to income tax expense. Okay, we're basically just reversing the entry that we recorded previously. And then real quick, disclosures. There's lots of disclosures that are required for tax, all kinds of tax disclosures on the 10K, including a roll forward of unrecognized tax benefits. So this is the liability we're talking about, and it's for 3 years, and you have to just go from your beginning of the year uncertain tax position liability to your end of the year, and these are the categories that have to be stated. The increases related to prior tax position, decreases related to prior tax position, so on and so forth, and some additional ones if they're material enough. So just want to make you aware that there is a disclosure related to these uncertain tax positions.